Treasury yields pulling back just a bit after the Federal Reserve cut rates by 25 basis points on Thursday. Yields poised to hold on to a second day of declines after surging on President-elect Donald Trump's win Wednesday. So how should investors be positioning through year end? I want to bring in Brian Rehling. He is the head of global fixed income strategy at Wells Fargo Institute Investment. Brian, it's great to have you here on Yahoo Finance. So we have it up here on the board. You've got the 10-year yield pulling back just about another 4 basis points here this morning, right around that 4.3 level. How are you making sense of the action that we've seen in the bond market this week?
Well, I mean, this makes sense, right? I mean, we've seen the trend of higher yields even before the election as markets kind of anticipated the outcome. And then, of course, the reaction after. You know, many of the President-elect Trump's policies are somewhat inflationary when you talk about tariffs, you talk about further tax cuts, et cetera. And so, you know, that's got the bond market a little nervous. But again, I think you also have to contrast that with the fact that one of the major items he ran on was to keep inflation down or bring inflation down. So, you know, we'll see how those somewhat conflicting messages end up being implemented over time.
So, Brian, as we do try to work through the conflicting messaging that we are getting from President-elect and his team, I guess, what does that tell us just about the volatility that we could continue to see as a result then in the bond market?
Yeah, I mean, you know, earlier in this year, the 10-year was almost at a 4.75, right? So we've seen volatility this year well before the outcome of the election was known. And I do think, you know, we're likely to see that volatility continue, maybe to an even greater extent as we understand exactly what policies will be put in place and how quickly they might be put in place. There are some things that, you know, the president-elect can do through executive action, such as tariffs, et cetera. But, you know, there are other things that he will need to pass laws through Congress. And, you know, there's going to be pretty narrow margins, especially in the House. So we'll see what can actually end up being implemented as policy. And I think the bond market will react as such.
Brian, what's your advice then for how investors can take advantage of this?
Yeah, we're taking advantage of the backup in yields, right? So we have an environment where the Fed is lowering short-term rates. So, you know, money markets, cash, you're going to, again, continue to see those income streams decline a bit. Now, our most favorable sector, the sector we like the most would be intermediate fixed income. I think it makes sense to take a little duration, move out a little bit, take advantage of the yield curve steepening, take advantage of the higher yields. You know, I wouldn't get too far over my skis on long-term fixed income, though, until we have a better idea of exactly, you know, what policies might be put into place and how it could impact inflation and the bond market.
And Brian, when we're trying to figure out just how some of these policies could impact inflation, the bond market, and the list goes on, I'm curious what you made of the comments that we got from Powell yesterday, just the fact that he did remain optimistic on some of the improvement that we are seeing in the economy, the fact that he does remain confident that inflation is on this downward trajectory, but leaving the door open just in terms of what the pace of those future rate cuts are going to look like.
Yeah, I mean, the Fed is going to react to the data. They're not going to react to, you know, campaign promises, other things, speculation, et cetera. So the Fed is trying to get to a neutral rate. You heard that from Powell yesterday. We're currently kind of above that level in restrictive territory. I don't think the Fed is in a hurry to get to the neutral rate just because the economy, as you mentioned, is doing quite well. So I would think we'll continue to see a slow pace of rate cuts as long as the data continues to support it, as long as the economy remains relatively healthy until the Fed feels that they have achieved that neutral rate.
Brian, what's your assessment just in terms of, as we do wrap this up, the biggest takeaways from the market this week, obviously, was the announcement that we got from the Fed yesterday, and then also the decision that we're getting on the 2024 election. It's clear as we have seen the market's reaction play out, but what would you say is the biggest risk here as we look ahead to 2025 with the second Trump administration? Is there a biggest risk that is posed here to the markets?
You know, I would say the risks at this point, again, much uncertain, but the risks at this point are that the policies that end up being enacted turned out to be, you know, more inflationary than the market had perhaps priced in. Now, I'm not jumping to conclusions. I'm not going to assume that's going to happen. We'll have to see what comes of it. But if I look at kind of the tail risks, that side is probably growing a little bit in concern, more so than the other side, which would be, an economic slowdown / recession that has had the market worried, in the past. I think that's a little less likely now, kind of given some of the policies that might be enacted here in the short term.
All right, Brian Rehling, Wells Fargo Investment Institute, head of global fixed income strategy. Thanks so much.
Right, thanks.